Welcome to our Taking Stock episode for the week ending the 22nd of November 2024. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Mathew Swartz, to stream to all things share markets. Welcome, Matt. How are you today?
I'm very well, thank you, Ken. It's good to be joining you.
Great to have you on board, Matt. There's so much going on in the markets this weekend. But before we get started, just a quick yet important reminder that the information we provide today is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile. And so any past performance figures shouldn't be relied upon as a guide for future performance. Well, Matt, it's another big week for equity markets. Geopolitical tensions between Ukraine and also Russia have raised concerns among those investors, especially given that both the US and Australian markets have hit new highs over the week. But to clarify, Ukraine struck a military base in Russia using its recently acquired long-range missiles, and now that's sparking fears that Russia could retaliate with nuclear weapons.
Yeah, pretty scary, isn't it? And the market, for the time being at least, appears to be ignoring much of this geopolitical risk and concentrating more on US earnings. And over the week, US chipmaker and artificial intelligence company Nvidia released its third quarter 25 earnings results. And again, it was a very solid result that beat market expectations and demonstrated very strong operating growth as this AI investment cycle continues to remain really strong. But perhaps the market reaction was a bit muted to the number as its revenue guidance maybe underwhelmed some investors for the next quarter.
Yeah, I think with the share price rises, a lot of the good news appears to be factored in there, Matt. And there has been a few US themes impacting our star stocks as well. For instance, this week, a global flu vaccine manufacturer, CSL, they face increasing share price pressure after President-elect Donald Trump appointed Robert Kennedy Jr., the nephew of former President JFK, to lead the US Health Department. And the problem here is that Mr. Kennedy Jr. has been an avid skeptic of vaccines, previously calling the rollout of COVID vaccines a crime against humanity. And so the risk is that Kennedy may cut funding for drug development, and this could delay drug approvals, creating another layer of uncertainty for CSL, which has already been impacted by delays to its growth pipeline after it had to discontinue studies on three therapies following US regulatory concerns. So we are closely monitoring this situation, which could impact the outlook and positive earnings revisions for CSL.
Yeah, there's certainly been some colourful appointments in the Trump administration for his next term, that's to say the least.
Mm.
But a star growth stock that could potentially benefit from this news is hearing implant manufacturer Cochlear. And the reason for this is the business has faced increasing competition from its hearing devices from a vaccine manufacturer, which is Moderna, which is currently trialling a vaccine against birth defects that causes hearing loss in newborns. So the concern is that the vaccine could potentially reduce the uptake of implants over time. Hence, those that are concerned with these political risks for CSL may want to switch their exposure to Cochlear instead, which is also trading below its highs.
Yeah, very interesting take there, Matt. Moving across now from healthcare to retail. Accent One Group provided a trading update at the AGM, which led to an 11% decline in its share price on the day. But the trading update, it looks reasonable with like-for-like sales growth for the first 7 weeks of the year, steady at around 3.5%. So why was the price reaction so severe? And do you think this represents an opportunity?
Yeah, maybe. I think the share price reaction certainly seems like an overreaction, with the market finding some buyers after it fell to as low as or to its lows of about 16% over the day. At 3.5% like-for-like sales, we're slightly below market expectations at about 3.8%, but not too much. And total sales were up 6.8%, which is also slightly below the first half 25 consensus expectations of 8%. So it was a slight miss, but not too bad, particularly compared to some of the other retailers in the market. Its gross margins were the real miss, so that's perhaps where the share price disappointment came into play. The gross margins were down about 70 basis points year to date, worse than the 40 basis points expected by the market. And the company had to implement more promotions to generate sales, so it's been a discounting period, hence why we expect some soft negative earnings revisions to flow through after this.
Yeah, Matt, interesting under Golden Rule 3 there. But on the positive side, though, the store rollouts are exceeding expectations. They are guiding for 40 new stores in the first half, with at least 50 planned for the full year 25 period. Even with the divestment of Tribe stores and also the closures of some of their glue stores, the consensus for 2 new net stores this half seems way too low. So, a potential opportunity here. And moving on to software provider Technology One, the company reported its full year results this week, and the numbers came in as expected, but the stock saw significant rally, up about 10% on the day. So, Matt, what's driving this reaction?
Well, Ken, it's all about confidence in the growth story. The
Mm.
market was encouraged by the upgraded annual recurring revenue target, now set at 500 million by the first half of FY25 instead of FY26. So they're ahead of target. The company seems to be delivering on all fronts: cash flow, profit growth, and an ambitious target like 1 billion in annual recurring revenue by FY30. So they are confident to provide investors with some clarity around where they expect to go over the medium term, which is encouraging, I think, for all investors. So it's not surprising to see the stock trading at a premium to its fair value, given that long runway for growth. But what should investors do, Ken?
Yes, a good point, Matt. Technology One is trading at that premium because it's seen as a high quality business with strong growth prospects. However, that premium valuation reflects a lot of optimism, and the return on equity is actually expected to decline in the coming year as well. So, those who are overweight the stock may want to consider taking profits. Otherwise, if you believe in the growth targets and if you believe they are achievable, you can continue to hold for the long term. And with updates coming hard and fast during the AGM season, we also had announcements from logistics software business WiseTech, which downgraded their revenue growth guidance by around 27%. Also, fast fashion retailer Lovisa, they provided a trading update with same-store sales growth and new store rollouts for the first half 24 period to date. That's coming below expectations, but please refer to our commentary or contact our team of analysts for more information on these stocks. And looking at the week ahead, there will be no star stock results, although we will be watching a stock that's been on our radar for a while now, sleep apnea device maker Fisher and Paykel, who are expected to release their results pretty soon. Also, with the AGM season still in full swing, there'll be a raft of star stock updates. So make sure you go through the corporate calendar for full details. In Under the Microscope this week, we take a closer look at PWR Holdings, an automotive cooling solutions provider. The company specializes in high performance cooling systems, serving industries like motorsports, aerospace, defense, and even emerging markets like electric vehicles. Founded in 1987 by Keys and Paul's Wheel, PWR started with a focus on motorsports and has grown into a global player. So the company recently announced a profit downgrade for the first half of financial year 25, which shocked the market. What's been driving this, Matt?
Yeah, they're not alone in the downgrade cycle here as we sort of head through AGM season. But specifically to PWR here, the main culprit is the delay or cancellation of 3 niche OEM electric vehicle programs. These were expected to contribute to FY25 revenue, and their absence has left a noticeable gap, I guess, in terms of where the expectations were and where they're likely to land for the first half. So the aftermarket automotive parts segment has softened due to broader economic pressures, while costs from relocating their headquarters to Stapleton also didn't help with the increase in that cost base.
Yeah, they've got such a high fixed cost there as well, Matt. It seems like a perfect storm of challenges. Now, looking at the earnings prior to the announcement, they were already negative, but was this a warning sign?
Yeah, possibly, but we need to remind members that the original forecast earnings were downgraded due to higher than expected capital expenditures, and investments into new production facilities and headquarters are obviously within those expectations.
Mm.
With the latest update, management guided to lower revenue. However, because of the company's high fixed cost base, this made it vulnerable to revenue shortfalls, hence why the profit miss was so large. It's fallen straight through to the bottom line.
Mm.
So while the motorsports and aerospace and defense segments have performed quite well, that wouldn't offset the challenges in the EV and aftermarket space.
Yeah, so under Golden Rule 3, we would expect further negative earnings revisions to flow through, and the stock has taken a hit, fallen sharply from their highs. Is there a silver lining here, perhaps, an opportunity for investors?
Does depend on your view of the underlying business, I guess, but the aerospace and defense segment's 67% of revenue growth, and that's a bright spot. And the motorsport segment remains quite resilient. However, the company's exposure to this niche market and its inability to adjust its cost structure makes it quite vulnerable. For long-term believers in PWR's technology and industry position, this could represent a really good buying opportunity, but only if you're comfortable with the uncertainty which could last for some months.
Yeah, so a bit of a double-edged sword here. There's potential, but also heightened risks around its high fixed costs, the rising capex during a time when revenue is constrained as well. So the stock price has recently breached the SD30 TSR, so trend-sensitive investors will need to sell out and sit on the sidelines for now. In light of the recent earnings downgrade from PWH and also its corresponding share price reaction, a question that is often asked among our members is, how can I manage this level of volatility in my portfolio?
Good question, isn't it, Kien? And this does hinge on the importance of having some risk management in your portfolio management. Firstly, you need to ensure you maintain a very well diversified portfolio of at least 15 high quality stocks. And in this circumstance, say if you own, say, 20 stocks in your portfolio, each one would represent about 5% of your total portfolio if you were equally weighted. So a 20% decline in one stock will have a limited impact in your overall portfolio return.
Yeah, and at the stock level, Matt, you've also just got to be objective and leave your emotions at the door. Assess the stock according to your return and risk objectives. Has its financial health deteriorated? If so, you will need to remove the stock because of the high risk of insolvency, despite the fact that you may still like that stock.
Mhm. And if you are trend sensitive, consider applying one of our technical indicators, such as the SD30 TSR. If you're more comfortable in some of your own indicators, then by all means use those. But you need to be systematic with the approach here and sell out when your indicator or signal does trigger.
However, Matt, if you are fundamentally orientated as well, you need to view share price weakness as opportunity. And it would be best to wait for our final decision if it's a star stock and it's retained as a star stock. Ensure you read our commentary specifically around the active risk to understand why the share price has reacted negatively, and call the analyst if you are unsure.
And if you are holding a stock outside the star stock universe, you do need to ask yourself a few questions. Are the active risks once off, or are they expected to potentially linger into the next year? Is the dividend sustainable, and will it meet your income requirements for the year ahead? Or are there better opportunities elsewhere, and could I offset my realized gains with these losses for tax purposes?
Yeah, some useful thoughts there, Matt. But for stocks with earnings forecasts, another useful way to manage this risk as well is for you to invest in companies, say, for instance, with positive earnings revisions. And you can do this by setting up your alerts. And if the earnings revisions under Golden Rule 3, if that falls below a certain threshold, say -5%, then you can remove the stock. What our back testing has shown over the years is that investing in stocks using positive earnings revisions can contribute to market outperformance over the long term. You just need to control that churn that can occur in your portfolio with this factor.
Totally agree there, Ken. And look, at the end of the day, it's almost impossible to get everything right, and there will inevitably be some losses in your portfolio. So the aim is to cut your losses and let your profits run.
Yeah, that's so important, Matt. Do not hold on to a stock just on hope that it will recover. Rather, be objective, assess the risk, and reallocate those funds to better opportunities instead of holding on to that losing investment. Anyway, that's all we have time for today. Thanks for your insights again, Matt.
My pleasure. Good to be joining you again, Ken. And do remember that to give the analyst team a call if you do have any concerns about a stock following a profit downgrade during this AGM season. Otherwise, feel free to attend our Lincoln Live webinar on Monday morning and ask your questions there.
It's great to have you with us, Matt. And for our members and viewers, take care and have a happy, healthy, and prosperous week ahead.